Harris and I am the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking.
Excuse me, Member Paris?
Yes.
I need you to sit a little bit closer to your camera because all we see is your background and not you. There you are.
Okay. Sorry about that. Is that better?
That's much better. Thank you.
Okay. I'm going to just continue or?
You can just continue.
Okay. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. I ask that those who are presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. At this time, we will begin with agenda item number 1. And that would be the approval of the minutes from our meeting of January 12th, 2023, the open meeting minutes. Is there a motion to approve?
So moved.
Okay, thank you. Is there a second?
Member Ardinger, I'll second.
Okay, we have a motion and a second. All those in favor?
Aye.
Aye.
Opposed? Motion carries unanimously. Thank you, members. Before we begin with the agenda item number 2, approval, contract SV 3092-0000, I would like to state for the record that I am recusing myself from this item, and member Dante Carroll will be the acting committee chair for this item. Upon completion of this agenda item, Natalie Henson will contact me so that I can rejoin the meeting for the remainder of the agenda. Member Carroll, please give me a couple of minutes to mute and turn my video off and walk out of the room before proceeding with this item. Thank you.
Okay, Natalie, do you think we're good to go?
Yes, sir.
Okay, David, I believe you're up to present the approval for agenda item 2.
Yes, thank you. Good morning, members. For the record, my name is David Green, Director of Policy, Innovation, and Performance, and I'm here to present contract number SV 00210791, also known as SV 3092-000. The contract name is Transportation Consultant Services, and this contract is to provide transportation consultant services for the MDTA. This contract provides additional consultant service resources as needed in the areas of transportation system analysis and needs forecasting, performance evaluation and reporting, and project management service and staff support. Examples of some of the type of tasks performed are capital program financial management consulting services, environmental permit program management services, support for our strategic plan and connected and autonomous vehicle strategic plan, and development of an ESG, environmental social governance primer for MDTA. The contract is advertised on July 20th, 2021. Bids were received on September 9th, 2021. 5 proposals were received. This was a best value contract where technical and financial elements of the RFP had equal importance. WSP USA was ranked first overall and provided the best value to the state with the lowest financial proposal of $8,698,099 and first ranked technical proposal. We are recommending award of this contract to WSP USA. There were no bid protests or neither was there rejection. This contract has an MBE subcontracting goal of 20% with no sub-goals and a VSBE subcontracting goal of 1%. WSP has submitted an MBE plan with a 20% MBE goal and 1% VSBE goal. The MBE plan is pending approval by MDTA's Division of Civil Rights and Fair Practices. WSP USA is also the incumbent with a proven track record in providing these services to the MDTA. Notice to proceed is anticipated in April 2023. This contract has a total contract term of 5 years and a not to exceed amount of $8,698,099. And we're requesting recommended contingent approval by the Finance Committee to present the above mentioned contract to the full MDTA board at its next scheduled meeting. I'd be happy to take any question.
Any questions from board members? Okay, David, one question just to confirm, because of the size of the contract, even contingent approval from this board, or from this committee to the full board then requires a Board of Public Works approval as well. Is that correct?
That's correct. That's scheduled right now for the April BPW meeting, April 5th.
Okay. Hearing no other questions, is there a motion to approve?
It's Member Ardinger. I'll move to approve.
I'll second.
All in favor?
Aye.
Aye. Hearing no opposition, this item is approved. Will, is there a comment? I saw you jump on screen.
Yeah, thank you. I just wanted to make a quick comment that, David talked about how we have this contract in its existing format, and the new contract that was just voted on will be used to help update our strategic plan. But I wanted to assure the board that we've already had a number of meetings to talk about the various aspects of the agency that we're working on towards that update. Things like, as you walk through our building, you've probably seen our diversity, equity, and inclusion survey that's ongoing. David mentioned the ESG primer that's been circulated. We had a leadership roundtable meeting. So we're targeting setting up a leadership advance in the spring that would have our team start to build out a new strategic plan that will look to make sure that we sort of check off the things that we accomplished out of the last strategic plan and celebrate those things, but also to sort of carry us forward, make sure we're in really strong alignment with the values and goals that have been set by Governor Moore and his administration. And so we're looking forward to that meeting. I think it's going to be a fun event for us to go out and try to focus on where we want to take the next steps of our agency. We've been listening to the board and taking a lot of good notes on values related to our fiscal responsibilities and revenue attainment, tolling accuracy, those kinds of important topics we're committed to address in the strategic plan. And we're already having those discussions. So even though this contract's not fully there yet, and we're waiting anxiously for that, we're not just sitting here idle. We've been taking some good actions already to help get us ready so that as soon as this contract's in place, we're going to hit the ground running on developing a new strategic plan.
Thanks, Will. And David, appreciate your presentation. Selena or Natalie, does somebody call John Von Paris back to the meeting at this point before we proceed to agenda item 3?
I'm calling him right now, sir.
Thank you.
He'll be on momentarily.
Thank you.
Okay. We will move on. Member Carroll, thank you for chairing the past portion of the meeting. Thank you very much. We will move on to agenda item number 3, the Investment Committee report. Alan and Clayton, good morning.
Morning. And we have Clayton on. It looks like he's loading up. This is our normal quarterly investment report. If you look at the first page there on the agenda and the key points, our key points are that the diversified investment portfolio remains in compliance with our investment policy and trust agreement. Our matched funded accounts are benefiting from the higher prevailing interest rates for the short-term instruments. And then for our total return investment strategies, we've been kind of repeating some of the same theme that the systematic rate rise is really impacting all bond market investors in the form of mark-to-market declines. What you'll see with recent performance is that that's starting to turn positive in recent months. Rates have sort of plateaued, certainly on the long end, and come down, and we'll get into that a little bit more. So we're starting to see some positive returns again in the most recent quarter. We're recommending that the strategies for our longer-term reserve accounts should remain consistent despite the short-term return volatility associated with generally rising interest rates. And the final point is really that our multi-year returns for these reserves align with our financial forecast, and they approximate the starting rolling yield. So in other words, our long-term returns are going to be positive, even though you see, 1-year trailing returns is still negative. And with that, I'll turn it over to Clayton. Clayton, your camera's not on.
The camera is on. I'm having a technical issue, so I hope you'll forgive me and that we can proceed. Is that fair?
Absolutely.
Thank you for your time this morning. As Alan mentioned, we're seeking your approval for a continuation of the strategy and the benchmark for the portfolios, both the match funding and the total return accounts. As we turn to slide 3, we see basically an economic summary of important measures for the economy, for the U.S. economy. Up at the top, we also show, as Alan noted, movements recently in Treasury yields on the right, middle chart, and then the bottom right chart, the changes in yields versus returns. I should highlight that at the top there, what we saw in January was a continuation of strength in the economy in terms of unemployment, where the unemployment came in at 3.4%, extremely strong, multi-decade strength numbers in the unemployment. Core PCE inflation remains sticky, and the Fed, notably Chairman Powell the other day, mentioned this is a continuing concern for the Fed, and will warrant further interest rate increases, and not only further increases, but for a longer duration. So while rates have, as Alan mentioned, stabilized the last few months, we expect modest increases going forward. On slide 4, we show the breakdown of the portfolios by asset type, asset class. You'll notice that the agency contingent is extremely high at almost 50%. And this is where we're seeing opportunity in the total return area, but we're also seeing compelling value for the match funded accounts. In fact, not shown on this report, which is also the next agenda item, is an inflow of $200 billion from the TIFIA loan proceeds. I don't know if we'll want to say something at this point or in a few minutes after, but again, that was $200 million that came in on February 1st and is not shown. Moving to slide 5, we show the The composition of the match funding and total return accounts, again, almost $800 million. That chart on the top left shows in the blue the match funding. We keep those match funding assets very short duration, short maturity, as there is a need to utilize those funds for capital spending of the agency. So we basically match those spending requirements with maturities. Are there any questions at this point? Okay, moving on to slide 6. We show the maturity distribution for the total return accounts. These are the general and the M&O, totaling $350 million. The general has a duration of about 2.7, 2.8 years. The M&O has a longer duration strategy of about 8 years. And so we're showing the breakdown by maturity for the two accounts combined. These bars tend to change a little bit over time, but typically this is going to be consistent with what you've seen in the past and what you should see going forward. Moving on to slide 7, as Alan mentioned earlier, the portfolios remain in compliance with the guidelines and the trust agreement. And we measure those, or part of those, in terms of maturity at the top part of the table there. And we're measuring for the fourth quarter calendar 22 here. So we're in compliance with respect to the maturity and the duration. And we're also in compliance with respect to issuer and security type or asset class. They're at the bottom. And we're obviously happy to report this and do so on an ongoing basis. Moving on to slide 9, we again wanted to show the breakdown of the total return versus the match funding. You can see that the agencies, the majority of the agency's assets are in match funding strategies or assets. Again, this is going to be consistent with the agency exposure that we showed earlier in that pie chart. Very short-term investments intended to be consistent with spending requirements. Moving on to slide 10, the strategy remains consistent. Again, we're seeking your approval to continue this. And I don't know if there's anything of note other than to say that, again, we're targeting approximately 3 years for the general account duration and then approximately 7 years for the M&O account. Alan, do you wish to add anything?
I think you're covering it well. Thank you. I guess switching over to slide 12, I'm sorry. Yeah, I think you want to hit slide 13 first, and then I'll jump in at slide 12.
Okay, I have at the top right there, slide 11, the total return performance. Is that what you?
Yes. Yeah, if you want to cover that one, and then I'll cover slide 12.
Sure. And so this slide covers the performance for the various accounts. Again, the match funding and the total return we break out separately. That's important to show. Match funding consists of the capital account, the construction, and then the various bond service accounts, which we aggregate here. Those are in line with short-term performance indicators in the markets, and there are definitely not any surprises, and never should be. The total return for those longer-term accounts, the general and M&O, are consistent with their benchmarks. And what we show at the very bottom of that table is the composite agency strips, just weighted according to the assets. And so we've recently seen a lot better performance, as Alan alluded to earlier, with respect to not only a total return, but a relative return as well. And in fact, January, we don't have final numbers for the portfolios, but for the indices in January, the shorter duration agency benchmark did about 1.1%. And then the longer duration Treasury strips index did almost 3%. So very, very compelling returns as rates have stabilized. On the bottom right chart, the bar chart there, you can see that that performance improvement has occurred, with the 1 month return in December. Moving on to slide 12, this is Alan wanted to speak to this.
I think it's, maybe a little helpful to see it graphically as well. What's happening is that, if you look at the gray line that's, rising, that's, interest rates, and the impact of that is in the very lowest line, as those are the monthly returns. So you can see, as interest rates are rising, those monthly returns are all in that negative territory until you get out into, kind of the November, December time period. You can see we circled that in the gray line, and you can see that rates are starting to come down modestly. And in fact, what happens with the orange line, which is our total return at the bottom, is that it moves back, quickly into positive territory for those 2 months. And just on a little perspective on the Fed and the debt ceiling is that, the T-bill rates, recently since October are up, 20 to 90 basis points, so sort of inside of 1 year. And this is kind of typical of a debt ceiling crisis where the market will price in additional risk in the front end of the curve, around the time period when, these sort of extraordinary measures might potentially run out. But the rest of the curve is really anticipating an end to the Fed tightening cycle, the slowing of inflation, and, potentially a recession. So in the 5 to 30-year maturities, they're down approximately 50 basis points since October. So it's a fairly substantial decline there. And that's why we're seeing, some positive impacts on our performance, particularly on those reserves that are invested a bit longer. And then, we've got some opportunities on the short end. The distortions caused by the debt ceiling crisis, and continued Fed hikes are really giving us opportunities to invest above 4% in the very short term. So that's positive. And that really takes us to the conclusion. And slide 13 is that we're, as the investment committee, we're requesting that the finance committee concurs and recommends that we move forward to the full board for an approval of the continuation of the investment strategy and benchmarks.
Make a motion that we continue the investment policy that we've been pursuing.
I'll second that.
Okay, we have a motion and a second. Is there any further discussion? Okay, all those in favor?
Aye.
Opposed? Motion carries unanimously. Thank you both for your presentation today. I appreciate everything you do on behalf of this investment team. Thank you.
Thank you.
Okay, we will move to agenda item number 4, TIFIA loan. Alan, you're still up, of course.
This is sort of a closing the loop and an update on the TIFIA loan draw. We previously locked interest rates back in last year, and we came back to the board. That was in April of 22. We came back to update the board in the following meeting, which was just a couple of days later. And now we're coming back to update you on the actual draw on the loan. So the rate lock occurred last year. We actually drew the loan on February 1st. And I guess the key point is that this early TIFIA loan draw allows the interest earnings to exceed the carrying cost of that debt during the spend out period. And I'll explain that a little further. There was a board resolution adopted in 2021 that delegated authority to the executive director and staff to close the TIFIA loan agreement with US DOT. And so that was all accomplished. And we had been targeting a draw, initially back when we were closing the loan in January of this year. And based on the rate environment and sort of this favorable rate lock that we had, we could move that draw date around, to our best advantage. And so we initially extended it out a full year and then pulled it back in, purely based on the rate environment. And I just want to point out that the financial forecast that the board approved back in November showed that loan draw occurring in fiscal 24. And so we're coming back to explain why the draw was accelerated and the advantages to the agency. So I guess another key point is that the loan payment timing didn't change at all because of the draw. We had always scheduled the payments to start in fiscal 24, and they run approximately 30 years through 2054. The only thing that's changing is really the accrued interest on that. This draw represents a reimbursement for the Nice Bridge construction costs that occurred in the May 21 through October 22 period. Those drawn funds, as Clayton had alluded to previously, were deposited back to our capital account. So they become unrestricted at that point, and they'll be utilized for capital spending in coming months through September of 2024. I guess the loan draw and the modification twice was about the interest rate environment. So when we locked rates and they're significantly higher than where we locked, last year, our effective loan rate is at 2.89%. And that's, well below prevailing interest rates. Where we were able to invest those proceeds is above 4%. So the agency is able to earn back a lot of the costs for closing that loan. And effectively, there's no carrying cost for the loan during this during the spending period. So we have several months until we start to spend those proceeds again, and we're not experiencing any carrying costs because we've essentially invested the money at a rate that's higher than the financing rate. On the second page, I just have a couple of key points. Again, it was $200 million. The purpose was for the Nice Middleton Bridge. The bonds are continuously callable, so if interest rates ever fall, we have the ability, unlike most of our muni financings that have 10-year calls, we have the ability to call these bonds and refinance them immediately. The true interest cost for the 5 loan tranches, each tranche has a different rate, but the effective rate for the loan in total is 2.89. The draw occurred February 1st, and the final maturity is 2054. The final point is really about a debt service reserve funding. It's contingently required, so if this agency ever obtains a debt service reserve for a future financing of any type of muni financing, a bank loan, anything, another TIFIA loan, and we supply a debt service reserve for those bonds in our loan agreement, the Build America Bureau would require that we subsequently fund a debt service reserve for this financing as well. Are there any questions about the timing of the TIFIA draw?
Alan, I don't have a question on that, but for the multiple tranches that are callable, would we have to redeem the entirety of the TIFIA loan, or can we redeem just individual tranches that may be of higher rate?
Yeah, and unfortunately, that we had tried to get that ability, and the Bureau, Build America Bureau, refused that. So it's sort of an all or none refinancing. One potential favorable element is that because the lower tranches, essentially the first tranche is fairly short, and it's a lower rate of interest. So, as that one matures, we would only have 4 tranches left to call. But yeah, unfortunately, it's kind of all or none. So we would look at, the effective rate on the remaining tranches and see if we could refinance those at any time at lower interest rates with tax-exempt muni bonds.
Well, if there was ever a model loan, the Nice Bridge would be one of them. I mean, would be the model loan in TIFIA's 25-year history. So I think that there's a lot of effort put into securing this loan, and those that did this on behalf of the MDTA deserve a lot of credit. So anyway, any other comments? Or we'll move on to, this is an update, so we will move on then. If no other comments, we'll move on to agenda item number 5. You go with that, Alan?
Thank you very much. Okay,
thank you. The second quarter budget comparison, review of actual versus projected spending for the FY 2023 operating budget. Jeffrey Brown. Hi, Jeffrey. Good morning.
Hi, good morning to everybody. For the record, my name is Jeffrey Brown, Budget Director of the MDTA, and I'm here today to provide an update for the second quarter year-to-date budget versus actual spending performance for the fiscal year 2023 budget. As of December 31st, we have spent 38% of the budget compared to a target of 49%. Just two objects, Object 3 and 13, were above budget. Object 3, communications, is at a 64% spend, but that's driven by the state telecommunications invoice, so we expect this to come back towards budget. Object 13, fixed charges, is above at 115% spend rate, and this is due to the payment of an annual insurance fee. We'll provide a little more detail later. All other objects are at or below the targeted spending levels. The primary drivers are personnel vacancies, delayed invoicing by vendors, and the timing or seasonality of the expenses. Moving into more detail, objects 1 and 2 are below budget at a 43.7% spend. This is driven by employee vacancies, and this effect can ripple through some of the other objects through the budget as well. Communications 3 is above budget at 64% spend. Telecommunications 303 is at a 25% spend, and again, this is a little below budget, driven by the vacancies. As mentioned above, state paid telecommunications is at a 92% spend, and this is accounted for by the state radio invoice. It actually came in below budget by $100,000. So going forward, we do expect this to be at or maybe even a little bit below budget for the year. Object 4, travel, is at a 23% spend, and this is driven by the timing and when the account or when the activity for travel typically occurs, which is usually towards end part of the year. Fuel and utilities, Object 6, is below budget at a 30% spend. Big driver is electricity, which is below budget at a 28% spend. This is driven by delayed fuel and utility billings for this area. We are actively going through reconciling some of these invoices coming through. We do expect full year to be on budget. Motor vehicles and operations maintenance is below budget at a 34% spend. This is dependent upon when the vehicle orders are filled, and we've had supply chain issues and there are delays in orders. So we do expect this to be below budget. However, we will roll those costs over into fiscal year 2024. Additionally, when we did this budget, gas prices were actually higher. They are starting to tick up again, or they had, but the budget was at a higher level, so we are running a little bit below budget as a result. And a lot of the its maintenance expenses are under warranty covered, so they are keeping costs below budget. Contractual services is below budget with a 28% spend. A lot of the drivers of this is timing and seasonality. For instance, on the first 3, advertising, engineers, and equipment rental, all of them are due to seasonality or the timing of the invoices when they come in. On all 3 of these, they are below budget, but we do expect them to come back towards budget. Equipment repairs and maintenance, 809, is over budget at 92%. This is the flip side. There was an IT bill that came through and has been paid for. It's a one-time cost, and we do expect that. We don't see any issues with this, and so we won't be above budget. We expect this to come back towards budget. Building repairs and maintenance, is below budget at 27% spend. This is more seasonality. It's more driven by higher expenses during the winter months, and we're right in the middle of that right now. So we do expect this to come back towards budget. On the next three items, which are education and training, management studies, and security services, all three again are timing. We do expect these to come back towards budget, even though they are well below budget at this point. For instance, like education and training, that's driven by tuition reimbursement, which is driven by when college semester ends. So that occurs at different timing points of the year. So we do expect these types of expenses to come back towards budget. Fiscal services, 829 is at a 41% spend, which is a little bit below budget. And again, we do expect this to be back on budget. The primarily IT objects, which are 841 through 869, are collectively at a 37% spend compared to budget. Again, as mentioned above with one of the IT invoices, these are all usually one-time invoices coming through. There's nothing to suggest that we will be above budget or below budget for that matter. We do expect this to come back on budget. Easy Pass Service Center costs, 873 is at a 21% spend. This is really driven, at least a majority is due to delayed invoicing as they come through from prior years. And also based on the latest expenditure forecast, we do expect this line item will exceed the budget. Other contractual services at 29%, and this is driven by the Maryland State Police invoicing. And there's, this is kind of the timing of the invoicing coming through. Again, this will be on budget. Supplies and materials, object 9 is at a 36% spend. The next two are seasonal items. The roadway maintenance materials is at 28%, and salt's at 2% or 0.2%. Again, this is driven by seasonality when winter months are typically heavier for the maintenance, and salt. As we're all aware, we had a fairly mild winter to date. So at this point, we do expect this to be below budget, but that's obviously dependent upon ultimately the weather. Uniforms is at a 36% spend. We are still expecting some shipments, so we do expect this to come back to budget. While ammunition's at a 68% spend, which is above budget, but that's driven by the annual TASER contract, which occurred in the first quarter and accounts for the variance. So we do expect this to come back to budget. Replacement equipment's at 41%. It's really driven by the older replacement equipment, Object 1099, and at 64% spend. This is due to we received replacement PP&E equipment, so that is really timing and will come back to budget. Additional equipment, Object 11 is at 10%, driven by additional maintenance and building equipment, which is at only a 3% spend, but we are awaiting the delivery of brine maker, which will bring this back to budget. Finally, fixed objects, Object 13 is over budget, as mentioned, at 115%. This is driven by insurance, Object 1309 at 133%, and this is due to the annual invoice from the Bridge and Tunnels Liability Insurance, and this is reflective of the insurance market and increased premiums that were unexpected. So that's what's driving that variance, and we will expect this to be above budget. That concludes my update. I'd be happy to take any questions at this time.
Any questions from any members?
Member Ardinger, I know all insurance has gone up, but that's a pretty hefty increase. Any thoughts as to why or any other options?
I would have to go back and go with the subject matter expert in terms of detail. I do know, like you just mentioned, it is premium driven. I think we did go to a new insurance carrier, so I don't know if there's ability to, shop around a little bit. I don't know about that. I'd have to follow up on that. But also was, I think some of the pricing mechanisms are driven by revenue as well, and we've had some increased revenues, so that is driving some of that. But it's mostly what I think is found in the insurance market. But beyond that, I would have to kind of circle back and delve into more detail beyond that.
Yeah. So Member Ardinger, Deb and I had a detailed conversation about the insurance premiums. Those were, they're provided by the comptroller's office. And so we looked at different options on what we can do there in terms of taking more risk on, in terms of, allowing for us to just bear the risk and essentially self-insure versus taking on this additional insurance. And after evaluating the full risk profile, we concluded that this was the most appropriate course of action. I realize that it's higher than in the past, but it's just a function of the current market conditions. But unfortunately, Deb's not here, and my memory isn't perfect to go through all of the specific risks that we talked about. But it was a very thoughtful discussion on the risk profile, and be happy to have her give a little bit of a follow up at an upcoming meeting on that decision making process.
Thank you.
It's a good question. I do have a question on the Easy Pass Service Center cost 0873. I know that we're under right now, but we anticipate to be over. Are we looking to find savings on this within the organization?
We are, even prior to Service Center, prior to these costs, we were in the process of looking at potential savings throughout the budget ongoing. So yes, the answer is yes, and that was already underway prior to this. So it's going to be actively looked at in terms of where we can offset some of these things.
Thank you. Are there any other questions from any members? Okay. Jeff, thank you very much. Good job, and we appreciate everything you do. Okay, thank you. We will move on to agenda item number 6, second quarter budget comparisons, a comparison review of actual versus projected spending for the fiscal year 2023 capital budget. Jennifer Stump. Hi, Jennifer. Good morning.
Hi, good morning. I'm Jennifer Stump, the Assistant Capital Program Manager. Today I'm presenting the second quarter review of the fiscal year 2023 capital budget versus actual spending as outlined in the fiscal year 2023 to 2028 draft CTP. This information will also be presented to the full board on February 23rd, 2023. As of December 31st, 2022, 38.8% of the fiscal year 23 $556 million budget was spent as compared to the targeted spending of 50%. Actual spending through the second quarter was $215.7 million. 21 of the 91 projects budgeted in the fiscal year 23 draft CTP were within acceptable spending limits of 25 to 75%. Due to normal lags in invoicing, a plus or minus 25% threshold is determined to be reasonable. In attachment A, it details 10 projects that were budgeted for more than $11 million each in fiscal year 2023. Actual spending through the second quarter on those 10 projects was $169.2 million. 4 of the 10 projects are part of the I-95 ETL northbound extension group of 26 projects. Thank you guys for your time. Are there any questions?
One question, Jennifer. So the electronic toll collection operating system that was 183% of the spend, so that will, I presume, catch up later this year, and that was just a timing issue?
I apologize. I do not have that information available, but I will get it and get back to you with it.
Okay. Thank you.
Any other questions? Okay. Thank you. Good questions, member. Good question, member Rosen. Jennifer, thank you for your time today.
Thank you.
Good job. Thank you. Okay, we will move on to agenda item number 7, quarterly update on traffic and revenue. Cheryl. Hi, Cheryl. How are you?
I'm good, thank you. Good morning, members. For the record, my name is Cheryl Lewis-Orr, Director of Revenue. And the purpose of this agenda item is to update you all on traffic and revenue performance through the second quarter of fiscal year 2023. A few key takeaways. We continue to track closely for passenger vehicle traffic levels to pre-pandemic levels. And commercial vehicle traffic levels continue to outperform pre-pandemic levels. On a system-wide basis, our transactions and revenue exceed our forecasts by 5.6% and 10.9% respectively. So I'll direct your attention to the table on page 2 of the memo. Overall, for the period ended December 31st, 2022, transactions totaled 85.1 million, which is an increase of 1.7 million or 2% over the same period last year. And our corresponding collected toll revenue totaled $404.7 million, which is an increase of $18.8 million or 4.9% compared to the same period last year. During the second quarter of fiscal 2023, transactions increased by 2.2 million and revenue increased by $13.5 million. And this increase was mainly due to the large amount of payments collected due to the customer assistance plan. And transactions for the period ended December 31st, 2022 were above forecast by 4.5 million transactions. And revenues exceeded the forecast by $39.7 million. This deviation in actual transactions and revenue compared to the forecast is due to a combination of factors, including our back office processing more days than forecasted, and we did have some collections of civil penalties from CCU and for the latter half of December. That concludes my presentation. There are some attachments that detail the timing differences and reconciling issues for forecast versus actual. I'd be happy to answer any questions.
Any questions? Member Armiger.
Yes. You're on mute, Cindy. Member Armiger.
Thank you. Thank you. First of all, thank you for the update. And I'm taking this as good news because it sounds like we're actually doing better than the pre-pandemic when we look at the uptick in the commercial. Am I understanding this correctly?
Yes, we are doing better. And now on the traffic wise, earlier, the actual traffic is better than pre-pandemic for commercial vehicles, and for the passenger vehicles, we're trending closely to pre-pandemic. As far as collections, it's a little bit separate from that, tracking the actual traffic. We're doing better because of the collection rate for the customer assistance plan. So that's on a cash basis, but we are doing better.
Good. Okay. Thank you.
You're welcome.
An overall good report.
Member Rosen, I have an answer for you. There were some incorrect charges in the first half on the 3G project that were corrected in January, and those adjustments will show up in the third quarter review.
Great. Thanks, Jennifer.
Thank you. Okay, well, we will thank you, Cheryl, and we will move on to the last item on the agenda, number 8, update on the 2022 Independent Auditors SOC 2 report. Hi, Chantel, how are you? I think you're on mute. I think you're on mute.
Sorry about that. Thank you. Good morning. Hope everybody's doing well. As Will mentioned earlier, Deb sends her apologies that she was unable to join the committee this morning. So I will be covering this item for her. For the record, I am Chantel Green, the Director of Finance here at the Authority. And as noted in the memo write-up, the purpose of this item is to provide the committee with the clarifying update regarding the findings reported by the Transportation Authority's independent auditor, SB and Company, regarding the fiscal year 2022 SOC report for the Maryland Easy Pass system. You may recall that when SB and Company presented its findings to the committee in October of last year, they reported its SOC 1, the Easy Pass system SOC 1 and SOC 2 report findings. And at that time, SB and Company noted a few minor exceptions or findings pertaining to the SOC 1 report and indicated that there were no exceptions or findings pertaining to the SOC 2 report. Since that time, SB and Company has issued its final report and has clarified that there were, in fact, SOC 2 report exceptions. However, it's important to note the SOC 2 report did not include any new or additional exceptions or findings that weren't already previously identified in the SOC 1 report. So it's important to note that the findings, they don't impact the opinion of the auditor. It remains unmodified for both the SOC 1 and SOC 2 reports. However, we thought it important, of course, to bring this item back to the committee to note this clarification. And with that, I'd be happy to respond to any questions. Thank you.
Hello? I'm having some technical difficulties here with my, if you can hear me, because I can't hear you.
Yes,
We can hear
I
you.
you.
My one computer went out, so I got onto the other one, but let me see, can't get to. Pardon me for a second here. Can you hear me?
We
Yeah.
can hear
Yes,
you,
we
John.
can hear you.
I can't
Can you-
hear anybody.
Oh.
I can't hear anyone here, so highly unusual. I guess that is, I'm sorry, I can't hear anyone. I turned my volume all the way up. Let me try another.
You're muted, Member Von Paris. Oh, I guess you can't hear.
Okay, there we go. Okay, I could hear whoever was speaking. Can you hear me?
We can.
We
Okay,
can hear
good.
you, John.
Wow. Sorry about that.
No worries.
That is really strange. Okay. So, Chantel, did you complete your report?
I did, Member Von Paris.
Okay. All right. Are there any questions? No questions. Okay. I'm the ones with all the questions on what happened here. So anyway, all right. Well, that completes we've covered everything on the agenda. And I thank all the members for their attendance. I thank all the members of the MDTA for preparing all this information. Will, I see you're up.
Yeah, thank you. I just wanted to follow up on Member Ardinger's earlier question about insurance. I sat here long enough and had some discussions with others that helped me remember the answer to the question. So we did look at and are continuing to look at three options with the insurance. One was to do what we ultimately did, which was to pay the higher costs for current market conditions. And those costs are reflective of, one, that nationwide there's been a lot of incidents of fires and hurricanes and just, natural disasters that are driving up insurance costs across the board because of the number of claims that have been filed and the inflationary pressures. So that's what we are seeing and what we were kind of informed by the comptroller's office. When we looked at this, we had discussed the risks and options associated with allowing for that increased insurance costs, allowing our deductible to go up, and to see if there were options to just consider ourselves self-insured. And the latter was kind of ruled out as not really feasible for this lost revenue type claim. And in terms of raising the deductible, that's still an option that we want to look at going forward. But we got some advice that essentially if we allow our deductible to go up, even if we later increased how much we would pay for the insurance, it will be hard for us to reduce our deductible later. So we didn't want to try to save money by going to a higher deductible right out of the gate, primarily because we were concerned that that obviously we didn't like the new higher costs, but just immediately accepting a higher deductible would without a detailed risk assessment of why we were doing that could later be viewed as penny wise and pound foolish if an event were to happen, that we would be using only our judgment, that we hadn't had prior claims and it wasn't really necessary to have the coverage at the level we did. And so we have elected to accept the higher cost at this point. Our team is going to perform a detailed risk assessment based on that deductible to see if it's reasonable to try to get a lower insurance cost going forward and accept a higher deductible, but to have a rational investigation of our risks to make that decision rather than just accepting the higher deductible using our judgment.
Thank you, Will. Sounds like there's a lot of thought that was put into this, and I appreciate that. Thank you.
Great explanation. I just comment on the insurance and from a transportation company standpoint, it's constantly it has increased. What we did was we pit broker against broker. Instead of maintaining one relationship with a broker, we pit broker against broker, and they brought in different options. And then from there, we did some self-insurance, but with higher deductibles and so forth. And then at the end of the day, of course, in the transportation world, both domestic within the United States and international shipping, it has risen and impacts the bottom line. Of course, customers end up paying for it. But anyway, thanks for the explanation and all you do, Will. Thank you.
Thank you.
So on that note, if there's no other business here, we will bring this, we will seek a motion to adjourn.
So move.
Okay, thank you, Member Rosen. Second? Member Ardinger? Okay.
Member Ardinger, I'll second. I actually think Member Carroll.
Oh, Member Carroll, okay. Member Carroll seconded. All those in favor?
Aye.
Opposed? Motion carries. Thank you very much, members, and have a great day. We stand adjourned.
I'll see you.
Bye, everybody.
Care.
Bye.